Imagine it's the year 2035. You're sitting on a beach, you're sipping coconut water or something stronger, I won't judge, and you check your bank balance. You see millions, not thousands, millions. And you smile because you never have to work again. But how did you get there? Did you win the lottery? No. Did you rob a bank? Hopefully not. The truth is, you made some smart investment back in 2025 and you never sold them. Now, I know what you're thinking. This sounds amazing. Tell me what to buy. Well, relax. Before we get into the 4 assets that could make you rich, make sure to subscribe to the channel. Otherwise, you may miss out on some valuable information, and in 2035, you might be working overtime and others will be enjoying that coconut water that you were dreaming about. So trust me, that's not what we want. Now let's get right into it. Number 1, real estate. Real estate is one of the oldest and most trusted ways to build wealth. It's the asset that turns regular people into landlords, suddenly obsessed with interest rates and market trends. But while many people have made millions in real estate, others have lost everything. So is it truly the ultimate investment, or is it an expensive trap? Let's break it down. Why real estate can make you rich. Real estate has one big advantage over most investments: leverage. When you buy stocks, you can't just put down 20% and borrow the rest. But with real estate, you can control a $500,000 property with just $100,000 or even less nowadays. This means when the property's value rise, your returns are magnified. If a $500,000 home appreciates by just 5%, that's a $25,000 gain. But if you only invested $100,000, that's like a 25% return on your cash. But hold on, we're gonna get into the risk part later. Another major benefit is cash flow. If you buy a rental property, your tenants pay you every month, which can help you cover the mortgage, property taxes, and even leave some profit. Well, not always. But over time, rent typically increases while your mortgage stays the same, meaning your cash flow gets better year after year. Plus, real estate is a hedge against inflation. As prices rise, so do home values and rent. That's why many wealthy people park their money in real estate. It holds value even when the economy is struggling. But what's the catch? Now we're talking. While the real estate can be lucrative, it's not all sunshine and rental income. First, you have ongoing costs. Property taxes, maintenance, repairs, and insurance can eat into your profits. And let's not forget the fun part: tenants. If you've got great tenants, life is good. But if you get the kind who calls at 3 a.m. because their light bulb went out, you might start questioning your life choices. Then there's market risk. People love saying real estate always goes up. Is it really? Well, history says otherwise. Look at 2008 financial crisis. Housing prices crashed and people lost homes they thought they were the great investments. And today, with the home prices at all-time high, there's always a risk of overpaying. If you buy at the peak and the prices drop, you could owe more than your home is worth. So when should you choose real estate? Real estate makes sense if you want stable cash flow and you're comfortable handling responsibilities of property ownership. It's a great option for people who want to be more hands-on with their investments. But if you just want to grow your money without dealing with tenants, maintenance, or market crashes, REITs might be a better choice for you. REITs, fancy name, but the idea is very simple. It stands for Real Estate Investment Trust. These are companies that own or manage real estate properties like malls, apartments, office buildings, or hospitals. Think of them like real estate mutual funds or ETF. When you invest in a REIT, your money is being invested in different properties without you ever having to fix a leaky toilet. And the best part, you don't need thousands of dollars of down payment to get started. You can start with just like $5. Yes, you would be owning literally a few bricks, but if you keep investing little amount consistently over time, that tiny slice can grow into something big as the value of properties appreciate. And while you are waiting, you also get paid a steady income, about 3 to 5%. Like a chill landlord who never has to deal with the tenants. Number 2, blue chip stocks. Now let's talk about blue chip stocks, the investment equivalent of a classic vintage luxury car. They may not be flashy, but they get the job done consistently. Blue chip stocks are large, well-established companies with strong financials and history of steady growth, and also a track record of surviving market crashes. Think about Microsoft, Coke, and Pepsi, Johnson & Johnson, and Home Depot. These companies that have been making money for decades and probably will be for decades more. Why blue chip stocks are a safe bet? Well, one of the biggest benefits of blue chip stocks is stability. These companies have strong business models, they have global reach and diversified income streams. They are not relying on one product or trend to survive. Another advantage is dividends. Many blue chip stocks pay dividends, regular cash payments to shareholders. This means even if the stock price isn't skyrocketing, you are still getting paid, and over time, reinvesting those dividends can lead to massive gains. Plus, blue chip stocks tend to recover faster in market downturns. When the stock market crashes, smaller companies can go bankrupt, but blue chip companies, they have cash reserves to survive and even thrive during the recession. Now, what are the downsides of blue chip stocks? While they are stable, blue chip stocks aren't fastest growing investments. You're not going to see a 10 times return overnight. If you're looking for explosive growth, you might need to look at high risk options. Also, while blue chip stocks tend to recover from downturns, they aren't immune to market crashes. If the whole economy is struggling, even the best companies will see their stock prices fall temporarily. So when's the best time to buy? Here is a secret. The best time to buy blue chip stock is when everyone else is scared. If a company like Apple or Microsoft drops like 30% in the market crash, you don't panic. That's not a disaster, that's a discount. An even smarter approach is to invest in these stocks through a fund or ETF. And one of the best options that includes a collection of top blue chip companies is SCHD. By investing in this ETF, your money is automatically diversified across these reliable giants without the need for any research or stock picking. Plus, you don't need to buy full shares of individual companies. You can start with as little as $5. On top of that, SCHD offers solid dividend payouts while delivering impressive capital appreciation over time. And if you're enjoying this video so far, hit the like button. It helps the channel to grow and tells YouTube that I'm not just talking to myself. Number 3, broad market index funds and ETFs, the lazy investor's best friend. If researching stocks sounds like too much work, but you still want great returns, a broad market index fund and ETF are your best bet. Instead of picking individual stocks, you buy a fund that automatically diversifies your money across hundreds or thousands of companies, and the most famous example is the S&P 500 Index Fund, which tracks the 500 biggest companies in the US. Why index funds are so powerful? Because first, they offer instant diversification. If you buy an S&P 500 Index Fund like VOO or SPY, you're not betting on just one company. You own pieces of 500 companies at once. Second, historically, index funds return around 10% per year on an average. Over the long term, that beats inflation and outperforms most actively managed funds. And best of all, they require zero effort. No stock research, no trading, no stress, just buy and hold. The only downside is they are not going to make you rich overnight. You won't get a 10 times result just overnight or in a year, but over the long term, your money will compound like crazy. If you want the best strategies to invest regularly, no matter the market conditions. This is called dollar cost averaging, and it beats trying to time the market. So which one do you prefer, actively picking stocks or passively investing in ETFs? Comment active or passive below. Number 4, growth stocks. Now let's talk about the exciting stuff, the stocks that can turn small investments into life-changing money. Growth stocks are companies that reinvest most of their profits into the expansion instead of dividend payments. Think Tesla, okay, maybe not Tesla, but think Nvidia and AI-driven companies. These are high risk and high reward plays. Why invest in growth stocks? The biggest reason is massive potential upside. Companies like Amazon and Tesla, okay, bad example again. Companies like Nvidia and Amazon, they were once tiny. Investors who bought them early made thousands of % in returns. Plus, technology is shaping the future. AI, automation, and cloud computing are transforming the industries, and early investors in the right companies can see life-changing returns. But be careful, because these stocks are volatile. One bad earnings report or earnings call, government regulation, or economic downturn can crash them overnight. And not all tech companies make it, because do you remember BlackBerry? Once everyone had one. It was the iPhone before the iPhone. Now it's basically a nostalgia item. And since I'm a big fan of investing through ETFs rather than picking individual stocks, I have got an even better approach for you. Instead of spending hours researching the next big tech or AI giant, you can simply invest in an ETF called QQQ. This fund tracks the performance of the top 100 companies listed on the NASDAQ exchange. NASDAQ exchange is the home to some of the most growth-focused businesses. By investing in QQQ, you're automatically diversifying across the multiple high-potential companies, saving yourself time, effort, and reducing the overall risk of betting on one single stock. Now, do you think AI stocks are overhyped, or are we just getting started? Comment below. So the key takeaway is diversify. Don't put everything in one basket. If you invest wisely and hold for the long run, you could be the one on that 2035 beach watching your money grow while others still chase quick rich schemes. Now, question for you, which one of these assets are you investing in this year? Drop a comment below and watch this video for more valuable contents just like this.